Welcome to the December 2025 monthly MOTR Checkup video. My name is Dave Lundgren, and I'm the Chief Market Strategist and Portfolio Manager here at MOTR Capital Management and Research. The name of the video this month is, well, it's our December video, so it's our annual forecast. And as always, there will be no forecast. And of course, I'll get into that, but the idea is that given our focus on current market regime and the change at the margin, the notion of an annual forecast makes very little sense, at least to us. I know there's a lot of strategists who publish their annual forecast for 2026, and while I'm a bit concerned about the fact that there's not a single strategist who has a negative outlook for 2026. As it stands right now, and we'll get into this, the actual structure of the market and the leadership and things like that, that does support a higher market in 2026. But we will go through this with an open mind, and we'll change our mind if the data should change. So this is not to say that we don't have thoughts on what might happen in 2026, but those thoughts don't impact our current view, which is based on what is happening right now. And so therefore, in this month, we're just going to review what the current regime is as we begin 2026. In many ways, it's a repeat of last month's video, but that's kind of the point. These are the things that are sort of we think underpin the most important observations about current market activity, and the fact that we oftentimes find ourselves repeating the same messages really is, we think, there's information in that alone. So from here, once we have a better understanding of what the current conditions are, we are actually better able to discuss what's not likely to happen rather than having to emphasize what will happen. And then we can then position according to that. So given current conditions, we remain bullishly positioned, open to the idea of a new era bubble, which we've been talking about for a while, in 2026. But we also have plenty of short exposure as well, which is reflective of and indicative of the environment we're in. So let's just quickly begin with the current market regime, and it's not that it's table pounding bullish, but what's most important is that it's just simply not bearish. And so we would characterize it, as we have been for many months, is that it's mixed, possibly risk on. So in that environment, you just really shouldn't be bearish equities overall. Now, and we'll talk more about this in a moment, but there's obviously plenty of things to be short beneath the surface. But as it relates to the broad market and the popular averages, we would say that it's mixed to bullish or mixed to risk on. So, some of the things that indicate how mixed the environment is: 59% of the market is above its 200-day moving average, and only 61% of the market has a rising 200-day average. So that's not bearish by any stretch, but it's also not robustly bullish. So we are left with where all of this lands in the risk gauge, which is mixed. And the fact that it's leaning towards risk on is a function of how close these timeframes are to getting into their own risk on readings. This one here, if we end the quarter here, which is, we've only got a couple hours left of trading at the end of this year, it looks like we're going to actually finish the quarter in risk on the long-term indicator. But and so that, again, that's clearly not bearish. But this one has not made its way into risk on yet, and you can see that it's red with a red font, indicates that it's closer to ticking down, and arguably very close to ticking down. So again, it's not that it's bearish, it's just not robustly bullish. And so therefore, we should try to allow that to be reflected in our positioning. Okay, so when the risk gauge does a good job of sort of aggregating everything into one simple indication of the overall market regime, and as we just said, it's kind of mixed to risk on. Within that risk gauge, there are multiple elements that come together to form the output of the risk gauge. Much of which is what you can see here. It's the quality of the leadership of the cycle we're in, the momentum of that leadership, and then the price structure and the relative performance, using relative performance trends, so absolute and relative trends. So let's take a quick look at that to see how we stand. Right off the bat, we want to just basically look at the top 10 ranked groups. And so here we're ranking by the momentum score, which is the longer term momentum, which is 3 to 12 months combined in an average. And when we sort by that score best to worst, we with the exception of pharmaceuticals, we're left with a pretty risk on cyclical type of exposure. And again, if the market was worried about what it sees coming down the pike, it wouldn't look like this. You'd see a lot more defensive groups in the leadership. And so we can say right off the bat that that's a good thing. And then when we look at current structure of the market, of the trends within each of these groups, this is where we start to see a bit of a mixed picture. But again, overall, leaning towards mixed to bullish. And so starting off, just as a quick reminder, this here is the medium-term trends. So these are trends that take place over months, possibly many months. So these are long-term trends. And we can see that the good news is that 59% of them either look like this or they look like this in that context. So, and again, in either case, neither one of those are bearish. So the fact that 59% of the market in that long-term trend is either in a straight uptrend, which is this clear uptrend, or it's in some form of a base of that uptrend, is at the margin more bullish than not. Where I'm clearly hesitating to say that this label is just as flat out bullish is the flip side to this is that 41% of the market looks like this or looks like this. So that's a significant percentage of the market that is not participating, and not only not participating from a momentum and relative performance perspective, but actually in price downtrends. So it just is what it is. And I unfortunately have been talking about this for a long time, but that is what it is. And nothing we can do about it other than recognize it and respond to it as it changes at the margin. One other way to measure trend, which I have here indicated here, is relative performance. So once again, here are the groups sorted by best to worst momentum. And now we're looking at relative performance. So obviously momentum and relative performance are two linked concepts, but they're not exactly the same. And there's many reasons to follow each one independent of the other because they signal differently. And so where we have the 10 best ranked groups from momentum's perspective, we can see that this one here, this clean energy, which has been one of our favorite groups, has recently come under very heavy pressure in the very short-term momentum. So remember, this is 3 to 12 months. This is 1 to 3 months. And we can see that it's under very heavy pressure. And that pressure has resulted in a net negative spread over the past 5 days of 1 month relative highs versus 1 month relative lows. So taking on a little bit of pressure there. And then when you go out to the past 10 days and you look at the spread between 3 month relative highs and lows, it's a significant decline or a significant edge towards more 3 month relative lows than highs. So we're taking on a bit of water here as a result of this pressure. The good news is that when you step out to the 6 month relative highs and lows, in the 1 year relative highs and lows, we still have positive spreads here. In the case of the 1 year, it's very positive. So this is a warning shot, but we don't quite yet see it as being terminal. When you dig beneath the surface and look at the individual charts, you can see this pressure kind of mounting, but most charts are still I would say neutral at worst, leaning towards bullish. And so that's of the groups that are in leadership, that's the one that's sort of at the greatest risk of displaying problems. And even there, it's not terribly negative. And then when you do look down here at the groups that are in the worst shape, you can see negative relative performance spreads across most of these groups. So indicating that there's once again there's a lot of problems in this market, despite the fact that the indices are displaying otherwise. So consumer durables is a very cyclical, very important group, and we can see that it ranks very poorly and more recently been relative performance lows. This is a positive development at the margin. When you come down to energy, you can see that it's been negative in this time frame and getting a bit better here. But so the main takeaway is that you can see that it's rather mixed. And when you get out to the long-term time frames of relative performance highs and lows, you can see that it's leaning more towards the groups that are down here continue to be uh, groups that you want to fade. Now, of the groups that are down here, what we can say that is not necessarily bullish, but it's kind of good to see like if something has to be at the bottom. Let's celebrate the idea that a lot of what's down here are the more services type groups on the one hand. Retail REITs, which is very defensive, software and services, which again is not the super cyclical part of the tech sector. So a lot of what's down at the bottom here, not entirely, but a lot of what's down here is relatively defensive, even within the groups that they're in. So industrials are very cyclical, but within industrials, this is the most defensive part. So, or the least cyclical part. And it's good to see that the least cyclical parts of the market are down here because when the market does start to display concerns about what it sees coming down the pike, those defensive and more in less cyclical parts of even the cyclical groups start to drift higher. So at the margin, this is what we're seeing. And again, it's not perfect, but it's also definitely not bearish. And so therefore we want to continue to maintain a bullish posture on the market. So obviously the S&P is working its way higher and it might be a bit frustrating as to why I'm not just saying why am I not just saying that it's bullish? And look, if I was to just be talking about the S&P 500 itself, I would say that it's bullish, but life doesn't happen for portfolio managers at the index level. It happens beneath the surface at the stock level, and this is where we see all these disconnects, and it's why it's almost like navigating through a landmine, a field of landmines, if you will. And so you need to be careful where you step. You can't just buy any stock because there are a lot of stocks that are not participating, not just by going up less, but actually by going down. And so this is a chart that I've been showing repeatedly, and I'm just going to update it because we have another important development to highlight here. But just to quickly refresh, this is the divergence that we highlighted back in late 2024, early 25 that resulted in this decline. And so this is the S&P 500, and this is the value line geometric average, which is in our view, is one of the best measures of market breadth. And you can see clearly with this blue line here, the clear divergences, and then the divergence that took place right at the very end there with the green arrows, and then that whole divergence resulted in what ended up being a pretty nasty decline into the April bottom. And then as we now have moved off of those lows, with most stocks rising with the market, very bullish off the bottoms, off of that bottom. But then since then, it's become thinner and thinner and getting more and more divergent, as you can see with these conflicting arrows. And then most recently, with the pink arrow, we've gone out to new highs once again with a divergence once again, awfully close and similar in structure to what we see here. And then stepping back to the big picture here, that this whole sequence itself is a very large divergence. So not only are these divergent in here with each other, just as these were divergent in here with each other, but the whole structure is divergent. So this is, again, it's clearly not bearish for the index at the index level yet, but it does warn of an environment that's increasingly more and more fragile structurally. So when you step back and look at the comparison of these two indices back to 2021, you just really see the divergences magnified almost. So the divergences I just walked through, that big one is right here. And when you step back and look to this chart here, which gets back to 2021, which also had its divergences off the highs, which preceded this, and this here, where everything went down together. This divergence, as I showed you here, this divergence is in place, but now this whole thing is also divergent. And this is really emblematic and indicative of an environment where these kinds of conditions at the individual stock level, this doesn't happen in a vacuum. There's a reason this is happening. And obviously, if you were to overlay this chart with the ISM into other economic indicators of economic health, which have been for a long time demonstrating economic weakness, then it's not surprising to see that the average stock is doing this. But the fact that we've ended that whole condition has resulted in this considerable divergence is what has our attention because ultimately, as I will show you here, these divergences over time tend to have tended to more often than not result in negative outcomes. So this is back to 1996, and here's your uh, S&P into the bubble of 1999, the internet bubble, and you'll note the divergences, the nested divergences that took place here, much like what we're seeing here with the big divergence in the nested divergence, right? But then we also, it's not quite as glaring here, but we had divergences here as well. And of course, we had this divergence heading into COVID, and we had divergences off of this top as well. Not as clearly evident in this long-term chart, but if you drill down beneath the surface or get into a shorter-term chart, you can see divergences that preceded it. So the idea is that when you have a structural environment where the indice is the popular average is moving higher, but the breadth beneath the surface is moving lower. This is where you want to pay attention. It's not necessarily act on it, but it's important to just keep this in mind as we kind of move into 2026 with an environment that just continues to get increasingly more and more divergent, much like it did back here and here. So the question obviously becomes, is the value line geometric average broken? Is it just not working? And you could make possibly the case that is what's happening. But before you conclude that, I would just point out this data set here, which again is something I went through last month, but it's worth updating once again here. So we're just taking that same list, best to worst from a momentum score perspective, and we're just looking at how each of these groups stack up relative to the 2021 peak in the 2021 trough. And just we'll take precious metals as an example, just we can walk through how to read the table, and then we can observe it all the way down as well. And hopefully that let me just get rid of that. So 2020 looking at the precious metals group relative to the 2021 peak, we can see that since the 2021 peak, 81% of the stocks, excuse me, 88% of the precious metal stocks have gone above that high. And let me just clean this up. And obviously, relative to the other groups, that's very high. We have energy is 95%. So the idea is that when you go all the way down to the bottom to the overall market, 63% of the market has since the 2021 peak has gone beyond that peak of 2021, which again is more than it's a majority. But it's also the case that means that 37% has not gone above the 2021 peak, and that's what the value line geometric average is showing us. What this column here is showing us is, although 88% of the market of the precious metal stock have gone beyond the 21 peak, currently only 84% are still above that 2021 peak. So when you go all the way to the bottom, 63% of the motor universe has gone beyond its 2021 peak, but currently only 39% are still beyond that 2021 peak. So there's been a big move higher and then a move lower off of that reaction high that has resulted in the 39%, only 39% being above the 2021 peak. So again, this is a table that brings to life what the value line geometric average is trying to tell us in graphic form. And so you could make the assumption that the value line geometric average is just broken, but this data suggests that that's a risky conclusion to make. And so this, to me, suggests that the fragility that you see in that disconnect between the S&P and the value line geometric average is very much real. And then one last point to make and illustrate this point is looking at the quarter to date returns of the 28 motor groups and sorting by the average return. So this is just the fourth quarter of 2025. We can see that there's been some very big moves, which is great, but we can also see that there's been some weakness. And when we look at the average return for the average stock in the fourth quarter, it's almost 5%. Obviously, the average calculation is skewed to the upside because of the this basically the skew of returns. But you can only be down 100%, but you can be up an awful you can be up 800%, which you can see that here, right? There's a number of stocks within the number one performing group, which is biotech, that have gone up, 500, 300, 400, 500%. So that skews this number higher. So if we just instead focus on the median return, which is a better reflection of breadth, we can see that the median stock is barely up, and we can see that only 52% were up, which means that 48% of the market was actually down on the quarter for the fourth quarter, and you can see these returns here. So once again, here's the S&P moving higher, but when you dig beneath the surface and kind of disassemble the market and look at the returns at the stock level, it's just divergent. And I think the value line geometric average does a really good job of displaying that. And I think the history of those divergences, do a good job of warning us that this has the potential to end negatively at some point in 2026 as it unfolds. So again, as it stands right now, we're still bullishly configured and positioned, but these are the things that we're monitoring for reasons to change that view and potentially get a more defensive exposure on. So I'm just going to finish up with this chart real quick. This is something that I ended last month's video with, and what I was highlighting at the time was this head and shoulders top that formed right before towards the end of 2024, and how it kind of head faked everybody and went out to new highs. As I illustrated in one of the first charts in this month's video, that new high was very divergent with the geometric average and other forms of breadth that we follow, resulting in a pretty nasty decline in the market. Now, obviously, that was also headline driven with tariffs and things like that. So, but nonetheless, it was the divergent condition that prevailed before those headlines that allowed for a pretty nasty decline because the underlying structure of the market was already negative. So then the point that I showed then last month was that we had a very similar head and shoulders pattern that my conclusion then was that I wouldn't be surprised if it went out to new highs, just like we did at the end of 2024, in the very same window, by the way, in terms of where we are located in the calendar. But what I would be watching for is whether or not it was divergent. And as I just showed you, this new high is once again divergent. So as we update this chart for what's happened since then, we have indeed, with the S&P, gone out to new highs. As I showed you with the value line geometric average and the other data tables that I showed you, the market is once again divergent. So we have this sort of nesting of divergent conditions. So divergent off the 2021 peak. We're divergent off of this peak here. This is a big divergence here. And then within this, we're just divergent once again. So that means to us that I think there's a chance that we can start off 2026 with a bit of a pullback, but the underlying conditions of the market are such that we should not be, at least as it stands today, we should not be thinking that it's going to result in something like this. But it most certainly could for the average stock. And so, just for now, as we begin the new year, we have a bullish positioning, but once again, we do have a lot of short exposure on, which is an important distinction to make. So if I said that we're 100% long, and that's all I said, you would think, well, that's really bullish. But if I told you that we're 100% net long because we're 150% long and 50% short, that's a totally different positioning. And so we are more aligned with the latter description of a bullish positioning, which is a net long positioning, but it has a lot of short exposure. And that's the reason it's like that is because we have the conditions that we've been describing throughout this video, as well as basically the videos all year throughout 2025 and even before that. So in summary, these divergences persist, and they're both in the short term and the long term. This structural fragility presents plenty of short ideas currently. So that the idea that there's a lot of stocks that are not participating means, by definition, that they are shortable. And so that's certainly something that I think we should be acting on. If you have the desire and or ability to be short, there's plenty of things to be short. But at the index level, these divergences don't matter yet as of now. That's not to say they won't, and then certainly it is the case that we do think eventually they will. But right now, as it relates to the popular averages, they don't matter. But that doesn't mean that there's no scope or room for short ideas, because the underlying structure of the market certainly warrants it. Bigger picture, as long as the leadership remains cyclical and medium-term trends remain stable, we will maintain a bullish exposure. But as I said, bullish exposure can take many forms, and currently ours includes a healthy dose of short exposure. So for now, we're open to the idea of a new era bubble, and we will participate in that bubble should it unfold, or continue to unfold, perhaps I should say, but with stringent risk management, just adapting to changes at the margin and monitoring closely the overall regime that we're in. So that's what we have for you this month. As always, thanks so much for watching, and best of luck for success in 2026. We'll do our best to keep you up to speed with what we're seeing, but we just wanted to say thanks for your subscription to MOTR Research and in 2025, and we look forward to working with you throughout 2026 as well. Thanks so much.